Is derivatives trading a zero-sum game, Mikey? Maybe you can speak a little bit to what a zero-sum game technically is and how people attribute it oftentimes to stock picking or futures trading or options trading. What does that term zero-sum game mean to you?
So in the option space, a zero-sum game is ultimately described as or defined as something where, like, let's say you have a 70% probability of profit trade, like the trades we were looking at earlier, 70%, 80%, 60%. Let's say, you're collecting X amount, your win rate is 70%, your losers are going to be 30%, and the losers should wipe out the exact amount of your winners. So zero-sum game would be you go through the motions, you have no P&L or no positive P&L, no negative P&L because the market is perfectly priced. And that assumes that the Black-Scholes model contributes everything or takes everything into consideration, which is just not possible given the fact that the Black-Scholes model assumes no skew. There's definite skew in a lot of these markets. There's the human nature aspect of things, which is really where the opportunities come into play, I would say. And that's, sorry, go ahead.
No, that's absolutely right. I wanted to definitely get into that because, the idea of zero-sum game is just like whether you're looking at a lot of people talk about it with sports gambling because it's actually a negative sum game if you don't have an edge. The whole idea is anything you do in any market is going to be zero sum unless you have some kind of edge. And we'll talk about a couple of edges in the derivative space here in a second. But in gambling, it's a negative sum game because they take a vig, right? It's like if these two teams are efficiently priced at the same exact team, buying or selling one of them costs you 10 cents for every dollar with that, minus 110 on the money line that you'd see to both of them. Thankfully, in futures and options, commissions are, depending on where you're trading, zero or a couple of pennies here. So you don't have that vig necessarily working down to a negative sum game. But how do we get past the feeling of every buy or sell just being a 50-50 shot in futures? We'll get to options in a second. But in the futures space, we commit these standard deviations. We update these values every single week and send them to our community members so that you get some of that edge. Because the idea to me, Mikey, is like buying or selling unchanged or 0.00. That's probably 50-50. I can't tell you that's betting, black or red. Like, is the stock market going to be up or down tomorrow? Of course, if it's on a losing streak, it's down 4 days in a row, then maybe there's some edge in buying unchanged. But we lean on these standard deviations because, to your point, when fear enters the market, that's when you get edge in your favor. We'll get to it in the options piece in a second, but standard deviations and day trading, to me, it's always like there's a range. The average range is 50 cents. A market is up or down more than that. And that causes, big funds, big hedge funds, big institutions to have to shift around money, or fear sets in. People want to liquidate because there's a big move lower or higher. That'll push that market then out of its average. And that's where we jump on. And to me, it's as simple as knowing the standard deviations. It goes to its average. It moves outside of it. And I'm getting on the other side. Is that making sense? Is starting to get some edge using statistics here?
Yeah, absolutely. And a lot of people ask questions about that with day trading and trading outright contracts. And it's all, you have to know the standard deviation range to give yourself the context of where is this market relative to where the market was supposed to be or where it was priced to be or move. And these are the situations like you have highlighted here. They give us the ability to figure out what the range is, look at where the product is relative to the range. And when we're at those one standard deviation or beyond ranges, it gives us a better comfort in fading that move and seeing a reversion back to the mean, which in that case would result in profitability if you're looking at straight up contracts.
And this exists in day trading. The short term, you can see here an example from Thursday of last week where US dollars have been up. Don't get me wrong. And I'm short in the longer term, but in the short term, US dollars were up and then they punched higher outside of that one standard deviation on Thursday. And then they came back pretty quickly. Price extremes on a day trade basis or on a long-term basis, huge, indicators for edge and getting on the other side, fading that move, like you say, banking on some mean reversion. But I do want to leave off with the options piece, and who better to speak to than Mike Butler here about edge in options. Because yes, instead of shorting that future in SFX, you can short the 161 call. That gives you a 60% chance. 162 call, a 70% chance. 163, 80% chance. But we've also seen via implied volatility and fear, institutions and everyday people alike, when markets get moving in one direction, they have to reach to buy insurance. And so that's where some edge comes in, where, they're pumping something that's got a theoretical shot of 70%. The premium's a little bit higher. So we've shown this historically, selling puts in stocks or selling calls in SFX, whatever. There's some overstatement, right, Mikey? And maybe you can finish with some edge in the options game that you've seen historically in stock options or what have you.
Yeah, there's definitely opportunity there. And when it comes to the difference between outright contract and extrinsic value, which is added into the option contracts, you have the ability to continuously roll these contracts. These contracts can be fluid. So when I roll from June to July, let's say the position doesn't work out, I'm going to pick up more extrinsic value. That extrinsic value could allow me to move my 157 strike short to 158. Maybe I could do that for a scratch. And if I can do that month over month, all I'm really doing is pushing my profit potential out another month, and I'm able to adjust my strike higher. So over the course of 4 months, it wouldn't matter if the US dollar stayed right where it is, because I have the flexibility to continuously move where my basis is. Where with an outright contract, you can't do that unless you are adding another contract at a higher price, which would bring your dollar cost average higher, closer to the stock price. So for me, I think when you're trading undefined risk options in a product like SFX or any of the other products, that extrinsic value just gives you the added flexibility. And like you're saying, the heightened implied volatility, depending on where you're selling that premium, it just adds to your profit potential in terms of probability. But again, it's a fluid thing versus more of a static thing in shorting or getting long the contract outright.
Awesome stuff there, Mikey. Thanks so much for joining me, as he does every Monday. Your absolute tops. You can get back to, I don't know if the Cubs are playing a day game or whatever. If it's a 1-10 start, maybe you can get there. But anyways, Mikey, thanks so much for joining me. Make sure you're checking this guy out elsewhere on the Tasty Trade network and also on Twitter and YouTube. He's got great YouTube stuff, Mike Butler, all over the place. And thanks so much, everybody, for watching. Make sure you take a look at our new promotion from Field Notes there, community.thesmallexchange.com. And with that, I will leave you with Splash into Futures coming up next. More small stakes tomorrow. Thanks, everybody, for watching. Have a great night. Peace.